Earnings week continues and our focus today is on Celsius, which did report before the market opened. We can take a look. It is now down around 2%. However, when the market did open, it did go down to around negative 10%, for which we can see it has recovered and is only now down negative 1.81. This is a company that has a double buy signal from Seeking Alpha, Wall Street, and a hold from Quant. So is this a very strong company that will give us some very strong returns over the long term? We can see market cap sitting around 18 billion right now. We're going to do our usual deep dive. We're going to take a look at both revenue growth from this company that has been phenomenal, as well as their bottom line net income growth. We're going to look at the balance sheet, the health test, looking very strong as well. This is a very good balance sheet. We will take an analysis look, and we'll see both insider ownership as well as institutions, whether they have been buying or selling over the more recent quarters. As usual, we will take a look at the underlying metrics like the free cash flow growth, the sales growth, and a few others. And what we also want to do today, given they did report, we want to take a few minutes to take a look at some very important information to see their very strong growth over the last few quarters. And as always, we will run them through the valuation model, getting to both our intrinsic value as well as our acceptable buy price, given as well Wall Street's forecast for over the next 12 months. And we'll also give a look at the DCF model, 3 different rates, a low, medium, and high, so you can also understand where these numbers are coming from and if you agree or you believe a different figure should be used. So in terms of a quick historical performance background, we do know year to date they have performed very strongly, up 44%. This is one that we did cover not too long ago, saying it does have some very strong long-term growth. Over the last year, up 120%. And when we expand over the last 10 years, some phenomenal growth, up nearly 30,000%. Now we can see it has cooled down slightly from the highs it saw at $99. It is now sitting in the mid to upper end of this region. We also note on a forward P basis, it is trading at 69.2, very high. So we're going to understand whether or not in today's episode this is justified. And we will kick things off now by looking at their top line revenue growth. Now look, we do typically want to say 3 to 7% growth year on year, but with a company like Celsius, a lot of very rapid growth, not just in terms of domestic sales, but also international expansion, which we will cover. 15 million of sales in December 2014, 1.3 billion in that latest annual report, and we can see just from this graph here that their growth has been exponential, increasing at a very rapid rate, hence one of the reasons why that forward PE does look to be very high. When we also look at their bottom line net income, we can see over the last few years, as well as in fact for a large portion of the period, they have been reporting a net loss. -2, so in fact what this means is a net loss of 2 million in December 2014, although we do note 227 million reported on the bottom line in that most recent annual report. And we can see again from the graph, it does look very inconsistent. Whilst their top line is increasing very rapidly, the bottom line a little bit more inconsistent. Good to note though, the last full year, some very strong numbers, 227 million. Now, in terms of the health of the company, their cash versus their debt, they had around, 0.3 million of cash, so 300,000 in fact in 2014, 756 million in that latest quarterly report, and we can see their cash position over the last few years has increased very rapidly. Now, what you'll find very interesting when we do our typical total debt numerical and directional analysis, that we in fact see it has not only decreased, but also very small, 10.8 million of total debt in 2014, just over 2 million in their latest report, which is always great to see. As I've mentioned before, cash rising, debt lowering, always a great sign, increasing strength in a company's balance sheet. So that is a very big tick there. In terms of their earnings, so what we can see in fact is how they perform versus analyst target. Over the last 4 quarters, we do note a miss in the more recent period, although we note 3 beats previously, so a 75% rate in terms of outperforming what analysts are targeting. And over the next 4 quarters, we do see some very strong growth anticipated, double-digit increases to that earnings per share. So a great sign if they do manage to execute on this very strongly. Let's have a very quick look then at their valuation grade. Now, they do get an F rating. Again, bear in mind this company is growing at a very rapid rate. Therefore, that is why the PE is very high. But again, whether or not you believe it is justified, the information is there to do your own due diligence and analysis. And we can, in fact, see on a PE basis, forward-looking 71.35, with others in the sector trading around 19.13. So it does get that very, very big overvaluation stamp. In terms of looking at their growth grade, well, it does get an A. In fact, A plus on the revenue side, up 102% year on year. Now, this is why their P is very high, because when we looked earlier, the sector median 2.81%. When we take a look, in fact, on a P gap, if companies are trading on a forward basis of 19.13, then essentially Celsius trading at 71.35 makes sense when we do see that the year-on-year growth is significantly outperforming the sector median. On the forward-looking basis, still expected to increase at a very rapid rate in comparison to the sector median, 56 versus 4. And when we take a quick look at other metrics, we also see some very positive signs here. In fact, we do also note that their operating cash flow growth on a forward basis, 41% versus the sector median of 9.67. Now, it is a company that is growing, but remember, we do always want to pay the right price, and we will cover that in our valuation model shortly. Profitability grade, then a B+. We note on a trailing 12-month basis, gross profit margin 48% versus the sector median of 35%. And on a bottom line basis, also very strong and healthy, 17% versus 5%. So looking very good. And we can also see when we do take a look at other margins and other measures, I just want to pull out that cash from operations does slightly struggle, 141 million versus the sector median of 841. Finally, we move on to how they perform versus others in the sector. No surprises then that some of their comparatives, Coca-Cola, FEMSA, other consumer staples, we have Suntory Beverages and a few others. Now, in terms of looking at performance just over the last year, as we said, Celsius outperforming up 116%. When we expanded over the last 5 years, there is no coming close to this, over 5,000%. And as we saw over the last 10 years, again, very, very strong performance. It has grown at a very rapid rate. So that is all good, but how about insiders? What are they doing? Well, 2.2% insider ownership, 13 instances of insider selling over the last 12 months for a significant amount, $328 million. In fact, just in the more recent quarters, we do see here over 160 million worth of sales. Now, who are these individuals? We can have a very quick look. And we do note the major shareholder, William M., has in fact sold not too long ago on the 3rd as well as the 6th of May. So just yesterday, in fact, as we can see here. So it's something just to bear in mind. In fact, just over this period, around $50 million. As always, though, do bear in mind, insiders do sell for different reasons. You can make your own decisions. We do show you the information for that full transparency. We do prefer to see insider buying to impact our analysis, as that is a very bullish signal, as insiders do buy because they believe the share price will go up. We just don't have that signal for this company. Institutional ownership then 61%, 447 million worth of sales by the institutions over the last 12 months. We do note a lot more buying, 2.54 billion during the same period over the 12 months. But we also note over the last 2 quarters, a lot more buying by institutions than selling. So overall, not just over the last 12 months, but also over the more recent quarter, institutions are buying more than they are selling. Now, before we do look at the underlying metrics, let's just jump into that latest presentation, which did arrive just earlier this morning. And the first thing we want to look at is their performance on a quarter-on-quarter basis. So Q1 of 24 versus Q1 of 23. On the revenue side, we note an increase of 37%, and when you break it down into the regions, North America up 37%, international very strong, up 43%. We also note on the gross margin basis as well, up very strongly, 7.4 percentage points. Net income also up 89%, and we can also see a earnings per share up very strongly. So an incredible performance just over the last year. So that is a very good sign that this company is continuing to increase at the levels that were expected. But when we do look at it over the last 5 quarters, just to point out that we do see Q3, it has started to drop down to Q4. And whilst we do see it rebound, we could note some seasonality due to the fact that it isn't a straight increase year on year. But this graph does show the very strong growth over the last few years. We then move on to the global expansion. So what we can see here is that they are also expected to move into new markets. We can see Australia as well as, in fact, France. So very positive to see they are moving across. Currently, they do have in 2024 the essential North America region as well as the UK. Finally, we just want to point out in terms of their market share across the industry, it does sit around 11.4%, some way away from Monster and Red Bull, but we can see this is increasing over the longer term, something that we will keep an eye on to ensure that they are able to continue to grow to justify that very high forward PE. Now, also, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any other articles, all completely free, do click on the pinned comment below and you can start reading. Also, just to let you know, this article here, it does run through all the websites that we use to analyze stocks, as that is a frequent asked question in the comments. So let's get to the metrics. Now, as always, free cash flow, look at companies that increase it on a year-on-year basis. They have struggled from 2014 to 2021, but what is good to note, the increase in 2022 to a positive, and that trend is expected to continue. Some very nice growth expected into 2024. Sales growth. Now, the major question with this company is, can they continue their strong double-digit growth to their top line? And what we've noticed, in fact, over the last few years, that has, in fact, gotten a lot better. We just note over the last 3 years, in fact, triple-digit growth to their top line. If they're going to continue their expansion into other countries as well, this will only help propel those numbers even further. And we do see how quickly their top line has grown over the more recent period in just a very different format to what we saw earlier. Now look, there's two ways to look at this. Shares outstanding has increased over the last 10 years. You would have been diluted as a shareholder, but on the flip side, the share price has increased so much over the last 10 years, as we can note here, just around 30,000%, that you wouldn't really care. But again, just something we do want to draw to your attention. In terms of ROIC, as always, 10% or more to give us faith that management are able to effectively allocate their capital. No surprises that it has been negative for a significant number of the last 10 years, given the fact they were loss-making. Good to know, very strong percent in 2023. If this continues at these high rates, then this will be incredibly attractive to more and more investors who will start to buy in. In terms of margins, well, we note again, no surprises, negative, in fact, a net loss over the last 10 years, as well as negative free cash flow. But what is good to note, in the more recent year, purely on the operating side, 20% very positive. And as we saw, they are expecting to increase their margin as well. In fact, on a gross margin basis, 7.4 percentage points, looking very strong. Then when we take a look at the margins, we want to see a minimum of around 5 to 7%. So nice to note, over the last 2 years, it is looking very healthy. Finally, we get to the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. Again, this signals the balance sheet strength, 0 being the number of years it would take the company to pay off all of their debt net of cash on hand. Won't even take them 1 day in 2023 or expected in 2024. So this is a very strong company with their balance sheet as well. Now, if this is what you believe to be a high-quality stock to add to the portfolio, then it's very important to look at the valuation, make sure you get it right. And as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, the only model that we do believe appropriate is the discounted cash flow model, and we will use 3 growth rates so you understand whether or not this fits into your valuation theory. Now, we have the discounted cash flow year on year over the last 10 years. Average growth rate, as we see, very volatile, some years negative, some year positive. We've started off today with a growth rate of 25%. It is expected to increase rapidly. Based on that, with a discount rate of 8%, you get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. And we can see the price based on a 25% growth rate gives us an overvaluation signal, intrinsic value of $52. As we can see, this would be implied downside, in fact, of 30%. We then move on to a medium of around 30%, and we can see here that would be an intrinsic value of around $71. Not too far off the current trading price, so overvalued / reasonable valuation. And then that would be an implied downside of negative 5%. And then for those who believe the growth will continue to accelerate at a very rapid rate, 35%, we have upside implied of 29% and a price of $97. As always, you can grab a copy of this model by clicking on the pinned comment below, running your own numbers through, whether it's for this company or others, then do click on that button. So what we're going to do is take forward to essentially the final slide, a 30%, the median rate, giving an intrinsic value of $71. And as always, the intrinsic value typically is the average of these four models. Given today's episode, we only believe the DCF model to be accurate, then this is the intrinsic value. Typically on the channel, we would look at a 10% margin of safety, and we'd start off with that and execute if it met 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Today's episode, what we're essentially signaling is that it is trading around its current value, so roughly at a fair price. But if you were looking at a 10% MOS level, it would be a buy around $64, at 15% around $61, and at 20% around $57. In terms of Wall Street and what they anticipate over the next 12 months, well, they see some very large upside, 30%. Their price target is $97.60, so they do believe this to be a very strong buy. But as we just saw, that does depend on what you believe the forward-looking growth rate to be, because essentially Wall Street are saying with their price target, they do believe it to be around 37%, getting to roughly around that $97 mark that they do see over the next 12 months. Again, if they do get essentially punished and they don't get that growth rate moving forwards, then that price will drop dramatically and Wall Street will revise their price targets. So always bear that in mind in your own evaluation. As always though, do let us know your thoughts in the comments below. Is this one you're looking to buy? Maybe this is one that is on your watch list and you're waiting for it to come cheaper, or for whatever reason it isn't one you're looking to add to the portfolio. As always, if you enjoyed the episode, smash that like button, hit that subscribe and bell button, let us know your thoughts below, and as always, we'll see you all on the next one.